All right, Bulls and Bears, we're back with another dose. We got a lot of news to get caught up on today, folks. Please make sure you're subscribed. Let's go ahead and get right into it. The devastation from the storms, it's going to create more financial pain for a lot of people. That's okay. We're going to show you how to beat this inflationary environment here. In this video, we're going to talk about a few different things here. But first, we don't have a total on the number of homes damaged. Quick update though, or quick revision. My last video, or was it 2 videos ago, I pronounced the hurricane, I think I said Helen. It's actually Helene. If I would have watched more mainstream news, I would have known that, but interesting name, right? Helene. October right around the corner, folks. I would say fasten up because things are not looking so good. The worst case scenario, prices keep going up. Now let's talk about the destruction here. We don't have a total on the number of homes damaged in Helene, but we do know just in Pinellas County alone, 19,000 just in Helenas County. We've got estimates out there, preliminary here, early estimates say $110 billion in damage so far. The economic loss, damages and economic loss, sorry, when you factor in everything. But that's okay because we've sent more than that. In a click of a mouse, we've sent more than that, more than 110 billion just for weapons and for war. So they can just print it, right? So what's the big deal? The big deal is you're going to end up paying higher costs for everything, all this spending. And not just that, just think about the insurance costs that are going to be going up. Not just in Florida, but a lot of states along the East Coast. I actually had a client in Tennessee, as far inland as Tennessee, saying that they had some impacts. Of course, not as devastating as the coastal states, but they felt the impact. There was some winds. There was some things blew over in Tennessee. That's how big that this was, this Helene. Anyways, let's talk about couple other aspects of this here before we move on. Also, the death toll was in the 60s last count, so there could be more by now. And the destroyed homes, the 19,000 damaged, not completely destroyed. Some of them with just anywhere from minor damage up to total losses. But when you look at the state of the U.S. consumer right now, most people don't have much extra money, if any, to go ahead and buy upgrades or fix and repair their homes. So it's going to be a very tough time, for a lot of people. And this is going to reach into, I think, the millions of people. We'll have to see what the numbers come out at. But it's not just property, it's vehicles. And when you add up everything, I think it's going to impact in the millions of people. We still have power outages in some areas. Are people not going to be able to go to their jobs because of the power outage? You have to factor that in too. So when you roll everything in together, total, I think it's going to be millions of people impacted here. We've got some inflation numbers out. The, of course, Fed is telling us that inflation is slowing down. But when you look at this more recent gauge that came out here, the core PCE price index, that accelerated actually to 2.7%. That's the highest since April. And that was on a couple different parts here. Higher core services inflation is up 3.8%. Durable goods actually down 2.2%. We're also seeing energy costs. We look at the price of oil. That's down year over year. But is that temporary because they've been draining the strategic petroleum reserves, right? So what do you think about that? Let me know, please, down in the comments. Is this dip in energy costs just a dip? Is it going to go right back up here in a matter of months because we've gotten so low on the reserves? Last I looked, it was close to a 40-year low, right in that territory. So it's going to be interesting to see what plays out here. October is a big month, as most of you know, if you've been on this channel. Not just big, but it's one of the biggest, riskiest months. Historically, when you just look at history, a lot of market corrections and crashes and implosions occur in the month of October. It's the first month of the beginning of the fiscal year. Just a lot of things happen, right? We look at market crashes, corrections, etc. So we're going to see a lot of things are going to be coming together, coming to a head. But then again, there's a part of my crowd that says it's a nothing burger because no matter what happens, they're just going to change the rules. And talking about the ones that control the money, couple examples of changing the rules. Look at 2023, the bank failures, pretty big banks with a lot of deposits. Silicon Valley Bank. A lot of billionaires would have lost their money, but they changed the FDIC limit to, instead of being 250,000, it was unlimited. Basically, everybody that had deposits in those banks, even the billion-dollar corporate heads, they got reimbursed because they changed the rules. So if they wouldn't have done that, that would have been a banking implosion because people would have been scared. They would have been freaked out. They would have pulled their money out of the bank. The bank runs, I think, would have really exploded from there if those initial banks would have been allowed to not just fail. They really didn't fail. They got consolidated, bought up by other banks. Not really failed. You could say the bank failed, but it just got bought up. And then the depositors were made whole, even the billionaires, right? If that wouldn't have happened, the confidence, I think, would have been, damaged beyond repair. And I think we would have saw bank runs that would have affected the entire banking industry. That's one example, recent example, just last year, 2023. Go back to 2020. Theme we've talked about here many times. Housing bust would have been at least twice as bad as 2008 when you look at the number of people that weren't able to pay their mortgage. But instead of getting foreclosed, people didn't have to pay their mortgages, and banks weren't allowed to foreclose. Otherwise, you would have seen at least a doubling, or not close to triple, but yeah, more than double of the amount of homes that were foreclosed. And many people say that would have had twice as bad of an impact on the prices if that were allowed to happen. So, of course, they could do a lot of things to prop this up, right? Coming up in October, will the situation that's coming up here, multiple situations, the new banking rules, the new student loan rules, what else do we have in October? The possibility of a port strike. Now, a couple of you in comments were saying, why, you're asking me, why do I think the strike will not happen? Well, I think the powers that be don't want it to happen. They don't want things to fall apart, especially right now, a month before November. But is it going to be too massive where these workers are going to strike no matter what? Some people say they'll just be replaced by cheaper labor. A lot of different possibilities, folks, right? There's no definites, right? If everything was definite, then we wouldn't have any problems. Everybody would be prepared for whatever was thrown at us. But all we could do is look at the possibilities, look at the risks, and try to buffer against those risks. But yeah, a lot of risk that I see coming up in October. As I've said before, I'm at the lowest point I've been as far as investments, and mostly cash right now, kind of like what Warren Buffett is doing. Not that I have a lot of cash. Most of my wealth, if you want to call it wealth, is tied up into my home. So I'm not living paycheck to paycheck, but if I didn't have income, I probably wouldn't last much longer than 6 months. Even though I've been doing very well on investments and things like that, it's just that the cost of living, it's affecting me too, especially if you have a family. I know single people without hardly any big expenses, even people that are single with their homes paid off, single people, not doing so well, like barely scraping by, like paycheck to paycheck, or social security to social security check, or direct deposit to direct deposit, whatever you want to call it. Single people, folks. I've got a family here in California, more than one kid. I'll just leave it at that. Also taking care of older people in my family, other financial obligations, folks. So, a lot of people are in this boat here. Even if you're not paycheck to paycheck, we look at a lot of other people. I'd say close to 80% are really, concerned about the direction of the cost of living. I like to say the economy, but it's not really the economy, because remember, when they talk about the economy and the economy growing, it's a lot of it's just spending. Most of it's just spending. And if you look back at that chart that we looked at just a couple reports ago, look at 2020, the GDP number spiked, even though the economy was shut down during that time. In that particular quarter, third quarter of 2020, the GDP spiked because of all the spending and money that was handed out, and the freezing of those payments, which allowed people to go out and spend more money. Remember, people had extra money. They went out and put down payments on cars, which caused the price of vehicles to spike up. We looked at that chart. The vehicle prices went like this for years, and all of a sudden, 2020 went vertical. And prices just now coming down, but not fast enough for a lot of people. A lot of people are struggling to afford these vehicle payments. We see vehicles getting repossessed. Those numbers are higher. The late payment numbers are higher. Credit cards, vehicle loans. We're going to talk about that here in just a little bit more here. But the Fed's preferred inflation gauge, again, we have to look at that and we have to ask ourselves, is that number phony, just like a lot of the other numbers? Now, when it comes to the savings rate, they just did a massive upwards revision. I did a little more research on that. They didn't just pull the number out of thin air. What they did is they started counting a bigger portion of the population as far as the average savings. So when you add in the savings and the cash of companies, that's what they're putting in now to the savings. That's what my research revealed. I'll have to get more on that because there was a couple articles that kind of sketchy as far as the sources, but I'm going to look more into that. So we saw this inflation affect people's savings. It was dropping down to below 3%. Then all of a sudden they revise it and they say, oh, by the way, for the past 2 years, it's been now closer to 5% is what they're saying. But they factored in a lot of the billionaire class. And what that does is that levels up the average, right? So think about, let me give you a baseball analogy. You have two hitters that are hitting, let's say 150, right? So for every 10 at bats, they're getting like one hit. But then you factor in somebody that's batting 1,000, maybe just over a couple games, they've got a hit every time. And you average all them out, maybe they'll be averaging 500. But when you look at it, most of the people are just batting like 100, 150, or 200. So averages, can really be skewed by a few big players at the top. You know what I mean? So we'll have to keep an eye on it here. But overall, the big picture is a lot of people are going to be hurt, especially when you look at the recent storm damage and the higher cost of living that's going to result from that, right? So we'll see how this plays out, folks. Some other news I wanted to get into, though. Return to office mandates ignite housing price surge in top 10 cities. We talked about this in the Case-Shiller home price index versus bigger, larger indexes or more broad indexes. We see the broad indexes, prices are down year over year. But what we have over the past year or two, is the return to office has people going back to the downtown epicenters, causing these prices to go back up in some of these larger cities, and that's the Case-Shiller home price index. So we try not to look at that too much because that's very skewed, especially by the back to work areas. Remote work gave folks the freedom to live where they wanted. No more daily commutes. No more being stuck in the city just because the office was there. And you have to ask yourself, if they were so concerned about the environment and less pollution, why are these big companies bringing people back to the office when all they're doing is sitting in an office on the phones, on a computer, right? They can do the same things at home that they can do in the office. Of course, the companies want to keep a better eye on these people and they think they're more productive in the office. But when you look at the overall cost of the energy, the gas, the pollution, again, if they were really concerned about the environment, about the pollution, why not mandate these companies that say, hey, no, if these people can work at home, you need to have them at home. Less traffic, better for everybody, better for the environment. Again, better for the traffic, the cost of gas. Maybe the price of gas would be even lower if you didn't have an extra 50 million people commuting back and forth to the office, right? Who knows? But it's just interesting when you hear these people making these decisions, they say one thing, but then they do just the opposite. And it's like that in a lot of places, right? Have you ever heard the term, I might get this wrong, don't do as they say, do as they do, or anyway, maybe you can give me the quote down below. I'm not the best on historical quotes. Don't listen to what they say, watch what they do. Maybe that's it. Let's take a look here. A couple other things I wanted to get into today. World's largest ski resort operator announces layoffs ahead of winter season. Vail Resorts is trimming its workforce just ahead of the winter holiday season, skiing season. Why would they be doing that? Right ahead of the skiing season, right? So have people, commercial start playing, have people, or too many people hit their limit. We know it's not everybody. There's people out there still spending money, but have too many people hit their limit where they're cutting back on these types of expenses, skiing trips, certain types of travel. We're told, though, if you want to believe the media, We're told that every holiday is another record holiday travel, and they look at how much is spent on those traveling trips, cumulative, and we're saying that the numbers are higher as far as the amount spent, but are more people actually traveling, right? So Vail Resorts, the largest mountain resort operator in the world, announced this week that it's trimming its workforce as part of its transformation plan. If you're going to transform, why would you do it right before peak season? That's my question. The company said it's eliminating 14% of its corporate positions and less than 1% of its operational workforce. That's another thing. The frontline workers, the ones that actually deal directly with the customers, sometimes their jobs are more secure than these higher level corporate positions. And I think companies are starting to look at their corporate staffing and ask themselves, do they need so many upper level managers? Or can a lot of that staff just be eliminated? According to an SEC filing on Thursday, Vail employed roughly 7,600 year-round employees and 44,900 seasonal employees the last fiscal year across 42 resorts. So that's pretty massive there. A war on the poor, 70-year-old. I'm not even joking, folks. Let me just bring this up here because some of you may not believe me. Think I'm exaggerating. Look at this. This is the situation with millions of people. A war on the old. 70-year-old with 84,000 in student loan debt worries Social Security won't be enough to survive if the SAVE plan is scrapped. There you go. Another program, another rescue program, assistance program, whatever you want to call it. Millions face the end of debt relief, folks. If it weren't all for all these programs, the assistance programs, down payment assistance, help with this bill, help with that bill, handouts, payouts, 84,000 in student loan debt and you're 70 years old. We've talked about this, folks. So many people are working, all the way up to, the point is to stop working and enjoy the time that you have after you're done working, after you retire. But most people are just working up until their first double hip replacement, right? Work until your double hip replacement. Like it's not supposed to be this way, folks. And you look at the U.S. and you say, well, yeah, it's better than this country, better than that country. Is it going to be for long? Because it looks like what's happening in other countries is just coming here. And, people think this is just temporary or we're going to get out of the woods here after November because we're going to have a new leader and they're going to change things. Folks, there's definitely topics that are big topics that emotionally affect a lot of people. So people are looking at these things. When you look at reproductive rights, when you look at, the border situation and other divisive wedge issues that have people, divided. But when you look at the source of cost of living, the source of the economic situation that, again, affects most people in that category of not doing so well / barely scraping by / paycheck to paycheck. When you look at the big picture that causes all this, it causes the high cost of living and these price levels to remain elevated, the popping up of the bubbles or the propping up, the consistent inflation of these bubbles. Those things, folks, not likely to change. We've got both candidates out there saying, we need lower rates, lower interest rates, more assistance, more handouts, more cancellations of debt or certain types of taxation. Folks, it doesn't look so good as far as like what's going to happen here next month or a little more than a month to really fix the broader issues from a money standpoint, from a money perspective here. A couple other things, folks, and we're going to get out of here. Cost of living likely just to get worse. We see this other inflation number, the cores, the Fed's preferred gauge, not looking so good, ticking back up to the highest since April. And we're being told that everything's getting easier, getting better, that we're almost out of the woods. Folks, to me, it looks like the woods are miles and miles and miles, and we're on this hike with no shoes. And we better hope something changes for a massive change, not little changes, not we're going to cut taxes here. I'm talking about massive changes. Some people say the massive changes are going to be even worse because we're going to have a CBDC, a central bank digital currency. Folks, get yourself invested if you can, if you have extra money, but a lot of people don't have extra money. Silver, little crypto, hedge against this, but also if you can, have cash in case of a deflationary scare situation that pops up here. Whatever it is, I think it could be coming soon, right? Let me know what you think about the timing and all this down below. Devastation of the hurricanes, the rising cost that will result from it. All this, folks. Anything else too? The 70-year-old with $84,000 in student loan debt. Insanity, folks, right? Give me your thoughts down below, everybody. Thanks for watching. Make sure you're subscribed. Very important time to stay ahead of the financial curve. Thanks for being here. We'll see everybody very soon. Keep stacking. Bye for now, and peace.